Welcome to the Deep Dive, your shortcut to getting up to speed. Today we're tackling quite a story. Opendoor Technologies, ticker OPEN. You might have seen it an absolutely wild 245% surge in July. But now their Q2 earnings are right here, and the big question is, will this so-called meme stock keep flying, or is it about to hit a wall? So our mission today is to break down Opendoor's business, figure out what's behind these crazy stock moves, and also unpack a really key idea for traders: implied volatility crush. Let's jump in.
Yeah, it's fascinating. Opendoor, at its core, is what they call an iBuyer.
Mm.
Think of it as a tech company playing in the real estate market. They use AI, algorithms, all of that stuff to make quick cash offers on houses.
Okay, so they buy low, fix them up maybe, sell high. The classic flip model, but supercharged with tech.
Pretty much. The goal is to resell homes profitably while making the whole process seem really smooth and stress-free for the sellers using their platform.
Right. But if they've got all this tech, why the roller coaster revenue we've seen? What's the catch there?
That's the multi-billion-dollar question, isn't it? So they make money mainly from a service fee, typically around 5%, charged to sellers. Plus, interest from their own mortgage lending arm, Opendoor home loans, and of course the profit margin when they resell the houses.
Okay, multiple streams.
Multiple streams, yeah. But the journey's been rocky. Founded back in 2014, went public in 2020, valued at, what, $4.8 billion? They actually hit a huge peak revenue, $15.5 billion in 2022.
Wow.
But then, it dropped sharply to $5.1 billion just 2 years later and kept falling through the end of last year. And that kind of instability, well, it leads us right into this meme stock conversation.
Yeah, and just quickly for you listening, a meme stock usually means its price is driven more by online hype and sort of retail investor excitement than traditional company performance. Open seems to tick a lot of those boxes.
It really does. I mean, the share price was beaten down. It dipped below $1 at one point. And even with the tech and a customer base, they face real headwinds, making, future growth look pretty uncertain to a lot of analysts.
So that massive 245% jump, what was the spark? You mentioned online buzz.
It was heavily fueled by it. There was this specific tweet from Eric Jackson over at EMJ Capital. He threw out a really bold $82 price target. That got a lot of attention.
$82.
Is it?
From under $1. That's ambitious. So does that just negate fundamentals entirely?
Well, it certainly highlights the power of sentiment, doesn't it? I mean, this speculative rally driven by that buzz actually helped Opendoor get back over the minimum price needed to stay listed on the NASDAQ. So it avoided a reverse stock split, which nobody really likes to see.
Okay. Practical impact too.
Definitely. And there was also a bit of a macro-level hope kicking in. Weaker job numbers had people thinking the Fed might cut interest rates come September. Lower mortgage rates would, in theory, help Opendoor's whole business model of buying and selling homes quickly.
Right. Makes sense. Okay, so this all sets the stage perfectly for the Q2 earnings report. And you mentioned this term, implied volatility crush. That sounds important for anyone trading around this news.
Extremely important. Earnings are famous for causing big stock price swings, right? Like 5%, maybe 10% in just one day isn't uncommon.
Yeah.
So implied volatility, or IV, that's basically the market's guess about how much the stock might move. Before big news like earnings, uncertainty is high, so IV spikes. This makes options contracts calls and puts more expensive.
Because there's a bigger perceived chance of a large move.
Exactly. But then the earnings come out, the news is known, the uncertainty vanishes, and boom, that implied volatility collapses. That's the IV crush.
Okay, so let me get this straight for you listening. If you bought options hoping for a big move, even if the stock goes your way, that IV crush can actually make your option lose value because the volatility premium just evaporates.
That's the paradox. It catches a lot of people out. Option buyers can lose even if they're right on direction. Conversely, option sellers can profit from that IV collapse, especially if the stock doesn't make a massive outsized move.
Got it. So for Opendoor's Q2 specifically, what are people expecting?
Expectations are actually pretty muted, really. Around $1.5 billion in revenue, basically flat, and a slightly smaller adjusted loss per share, maybe around 2 cents.
So the numbers themselves might not be the main event?
Probably not. The real focus, I think, will be on what management says, their commentary, their outlook for the future. That's what's going to tell us if this meme stock rally have legs, or if the people who jumped in recently are going to, head for the exits. Everyone will be listening for clues about the housing market, interest rates, their strategy going forward.
So this whole look at Opendoor, the earnings, the meme status, the IV crush, it really shows you that complex mix, doesn't it? You've got the company's actual business performance, then layered on top is market sentiment, online buzz, and then these sophisticated trading dynamics around events like earnings.
Absolutely. Open Door is almost like a live experiment right now in how narratives, especially those amplified online, can sometimes detach a stock's price from its underlying financials, at least for a while.
So as you follow the financial news, maybe think about that with any company. How much of what you're seeing is the business itself, and how much is just the buzz? And importantly, what does that difference mean for you?